Good day, fellow investors. The market is down a little bit and some say that it is pricing in a recession. Let me tell you something. If there is a recession, the S&P 500 goes down another 30–40%. The market now is not pricing in a recession. I've made this video whether it is smart to buy now or wait when it comes to investing, and there was this comment from Shifo saying how things are pricing in, how the market is always forward looking, and I really want to explain what the market is looking forward to, because there were many comments discussing whether the market is pricing in everything and pricing in a recession and therefore lower. And when it comes to pricing in, there is a lot to discuss, so let's start with earnings, then go to interest rates, discuss how a recession is actually never priced in, similarly to a dividend cut. If there is a dividend cut, the stock goes lower no matter what happened before, and then also discuss the investing environment to conclude. So let's start immediately from earnings. This is from FactSet, so if you just type earnings inside FactSet in search, you'll get this beautiful PDF with expected earnings for 2022 and 2023 for analysts. And you can see that the expected for the year is earnings growth of 10% and revenue growth of 10.2%. This is what the market is pricing in. Earnings growth of 10%. Wall Street analysts. If you look at the earnings, you can see here, yes, a decline in the market, but the earnings are still strong, the dark blue line. So if earnings expectations or earnings don't meet expectations, the market will change too, on the lower. Thus, it is not pricing in a recession. Now, 95% of companies have reported earnings for Q1, and the number of surprises on the negative side has started to go up a little bit. So if you look at Q1 versus the 5-year average, Q1 is the blue, you can see that the negative surprises have increased compared to average surprises. Still positive, everything still positive, beating expectations, but slightly trending downward. And you can see here that when a company misses expectations, you can see that the stock price 2 days before and 2 days after reporting earnings is down. So here 16% if you miss 40% the earnings number, and you can see if you beat, then the stock usually goes up a little bit depending on how much you beat. So if earnings, the big growth projections, miss, then you can expect further stock market declines. And just a note here on earnings, you can see here how many companies are mentioning supply chain issues, which means that they still cannot supply to customers, so everything is still good from a business side, but the market is going down, so the market is expecting something. Back to earnings, Q1 growth of earnings was actually 9%, so that's really good, great. So the market is still pricing in huge earnings growth ahead. As we have said, 10% for 2022, a little bit more for consumer discretion, industrials, a little bit less for energy and materials, as the market is expecting less inflation, so a slowdown here. But if we look at 2021 earnings, so 10% growth, and then on top of that another 10% growth in 2023. So earnings, as the market is expecting, are expected to grow 10% per year for the next 2 years. That's what the market is pricing in. And you can see here a nice chart showing how high can these earnings go. From 208 to 251. Nothing is stopping earnings from growth in this environment. And this is completely the opposite than what was the case in the early 2010s, when earnings growth was really slow, you can see here. But I don't know why. I don't certainly expect this growth to continue, but the market does. So we must ask Wall Street analysts what's the case here. And that's exactly also an investing advantage for us, or not. Analysts expect growth forever. I don't, so I position myself differently when it comes to investing. But let's now go to what is expected from the Fed related to the current earnings. If we look at the economic projections, so change in real GDP is expected to still be pretty good, 2%, then slow down over the long run, but no recession expected, everything great, so really good. Unemployment to remain low, so really great. And inflation is expected to slow down. If we look at interest rates and what the market is pricing in, they are pricing in the expectations around this perhaps a little bit higher here than when this was published from the Fed's meeting, but we can see interest rates around 3% in 2023, which means that expected returns from the market 5 to 6%, and that is what the market is pricing in now. 10% growth for the next 2 years per year in earnings, the Fed reaching 2.5, 3% effective federal funds rate, and inflation slowing down. So everything great in what the market is pricing in now. And be careful here, the market definitely does not price in a recession now. So this decline here, the 17%, is just pricing in a little bit higher than expected interest rates from the Fed, not a recession. If there is a recession, I would say that the S&P 500 goes below 2,500, below 3,000 for sure, and simply goes somewhere here very easily. So we are down for another 30, 40, 50% if things get really ugly with stagflation and the Fed forced to push rates higher no matter the economy. That would be interesting, but that's not priced in. Why is that not priced in? Because it's not in the interest of Wall Street, it's not in the interest of anyone for stocks to go down, everyone always projecting things to go higher and higher. And I've saved this report, and it will be very interesting to look back at this 1 year and 2 years from now. So for that, subscribe to the channel and smash that like button for support. And as I said, the recession is never priced in, but what actually happens if there is a recession? If we look at S&P 500 earnings, the current is 205. Look at the dips when there are recessions. It's very easy that given the current exuberance, this falls to 150. And if earnings fall to 150, and let's say the price-earnings ratio falls to the historical average of 15, if the Fed forces rates higher and higher to curb inflation, then we have the S&P 500, 150 times 15 is at 2,250 points. That's still a long way down from the current level. This is what the market is pricing in. If the Fed pushes this higher, then the market will price and value the market at a much lower valuation than the current. The current is 20, but if earnings contract and the valuation contracts, then you have lower S&P 500 levels, much lower levels. And this is because the market cannot think non-linearly. Everyone always assumes the current situation to prevail forever, never discussing a paradigm shift. The thing is that you can never predict such things, but you have to be ready for a recession, and you have to know exactly what you will do if the market crashes 50% over the next 2 years. That's something you have to have planned, be ready for, because if not, when it actually happens, and it will happen sooner or later, you will not be ready and you will do the wrong thing at the wrong moment in time. Because probabilities don't really matter. We don't know when it will happen, but it can happen even if there is a 1% chance. If it happens, it matters for your life and your financing and your well-being. Therefore, you have to be ready if it happens. Whether it's 1% or 50%, like the market is thinking, pricing in, it doesn't matter. Just be ready. And then what to do? Well, if we look at the S&P 500, the earnings yield is 5%, so that is the expected return plus a few percentage points of growth over recession, slower growth, but long term there should be growth, there are good businesses. But the risk is always that the valuation comes back to a normal historical, so that's another 25% decline if interest rates normalize to historical levels, because then you compare things. And to compare things, we can always go to my comparative table free for download below, and I have made an analysis this on the S&P 500 a few months ago. So if we click here, we see that the S&P 500 have made the valuation based on dividends, 59 points of dividends, growth rate 5%, stable growth rate ahead. If you are happy with a 2% dividend and the rest invested in growth, the intrinsic value for a 10% return is around 2,200 points. Of course, if I lower the discount rate, then 5% is what you can expect from this perspective. Of course, if the market remains happy with the current dividend yield, which is unlikely if interest rates go up, then for a 5% discount rate, you are already higher valued. But you have to see whether you are happy with this dividend yield and the likely growth ahead. Let me put this to 10% back. And I am not happy. That's why I'm not invested in the S&P 500. But for someone, this could be a good investment. And we made this video for the best strategy to invest in an index like the S&P 500. Of course, if you prefer stocks, you can find a lot of analysis here and my premium things where I look for higher returns here on the research platform. Also something that we will discuss on Friday, the Activision merger, for 20% returns but also with some risks. So the message is, as always, if you like the S&P 500, the dividend, the 5%, 6% long-term returns, nominal of course, then you buy that and you are happier if it goes lower. If not, you have a big list there of stocks you can check if you find something better and see what fits you. The key is that, okay, if something goes lower, I buy more of it. And that's something you have to expect when it comes to investing, because a recession is never priced in. So I hope you enjoyed this. I'll see you in the next video.